Hello, you ancient traders out there. This is General Romulus for what looks like to be the final video posting of 2025. That's right. The markets will still be trading for a few more days, but old General Romulus, well, he will not be fighting in the arena, not for a bit. Something is going on, however, that kind of grabbed my attention, and I wanted to bring it to yours as well. Something that I don't really know anyone else talking about it. Everyone's focusing on Santa Claus rally, and that is kicking in. American stock markets are at or near all-time highs, and they've been rallying for the last couple of days. Santa Claus rally. Also, a lot of talk about new equity highs in the first quarter of 2026. Well, really throughout 2026. You'd be hard-pressed to find too many major strategists from the big banks and broker-dealers out there, Morgan Stanley's, Goldman Sachs, JP Morgan types, that are bearish, that are looking for a negative return for 2026. And again, a lot of that focused in on the first quarter of this year. All kinds of good news that you can pick from. Taxes are going down, regulations are going down, interest rates. Well, that's what we want to look at right now. The Federal Reserve has been lowering rates, 3 cuts since the late summertime. And this is reflected in the three-month T-bill of the U.S. government borrowing cost structure. However, something funny is going on that is contradicting what we are seeing over there in the shorter-term bond yields. This is kind of messing with the yield curve across the board. And again, something that not a lot of people out there are talking about right now. And before we get too much further into the yield curve, bonds, and other kinds of issues that, well, I know tend to bore most stock traders out there and investors. They just want to buy NVIDIA at 10 and have it go to 500 overnight. But this is an important backdrop. U.S. government debt, which is demonstrated right here, $38 trillion, closing in on $40 trillion. We keep spending like this. We'll hit that number in less than 1 year. We will hit officially $40 trillion in U.S. national debt in less than 1 year. Like I said, slightly important to talk about this. I want to stress, however, that I am slightly bullish for, well, the rest of the year, which isn't too many more days, and into 2026 as well. I don't know about the end of the year, but certainly for the first couple of months. Price action and the underlying condition of the market, the internal condition of the market, under the hood type of structure is bullish. And as long as that maintains, then I am going to stay bullish. However, every once in a while, something pops up that really could start to become a problem a little bit down the road, maybe a red flag that is not going to close the beach. However, something worth paying attention to. And that is what I think is going on with this debt structure, the yield curve, and the U.S. government bond levels right now. So what we are looking at is the U.S. government debt 10-year yield. If the American government borrows $50 billion today, they will pay 4.186% for 10 years in order to borrow that money. Now think of this as a stock chart instead of a debt chart or a yield chart. This looks bullish, doesn't it? I mean, it has the falling 200-day moving average to contend with, some overhead supply over to the left. However, it does look like it's trying to put in some kind of a decent shaped bottom, perhaps even a longer term bottom. And this is the issue. That's part of the problem. The equity stock market will most likely have a hard time going significantly higher, maintaining a sustained uptrend. Too many S's in that word for me for a pre-holiday post. However, so the equity market could have, most likely will have, an issue putting on a sustained uptrend if the 10-year continues higher, breaks this 200-period moving average, and just keeps going higher as well. Now, take a look at this, though. We looked at the 3-month. Again, 3-month trending down, balancing out the last couple of days. However, in a downtrend and not breaking that downtrend as of yet. But look at the longer-term yields. The 20-year, above the 200-day, 200-day curving up even, about to break out. Look at the 30-year, above the 200-day. Look at the same type of thing. This is an issue. Part of my situation with this is, as you guys know, I've been posting about lower oil prices, and oil did break down from a significant support level recently, and then only about a week ago trading at a multi-year low. Have to go all the way back to 2021 to see oil prices this low. Hard to imagine where we will see a debt market, a rising yield market in an environment where oil prices are continuing to trend lower, with an ultimate target in the first half of 26 all the way down in the low 50s, high 40s. So what else could be going on here? I mean, inflation's not an issue. They just posted 2.7% on the CPI last week. Yeah, there was some anomalies with the data because of the government shutdown, but even without any anomalies, it would have probably been about 2.8 or 2.9, which is still trending lower over the last several months. We see oil prices going down, which is still the number one economic input on a global basis, which will help keep a lid on prices despite some rising price pressures from tariffs that were enacted earlier this year. It's still oil. That's the main thing. What is going on? Well, governments, the U.S. government primarily, but governments around the world have just borrowed too much money. And investors, the major, big, long-term investors, are starting to believe that while inflation is not going to be a problem today, tomorrow, or next week, 6 months from now, a year from now, 18 months from now, it will be a problem. And that's why they're looking to take these yields higher. I'm not ready to say that this is going to completely quash my slightly bullish bias in the stock market for the first quarter of 2026. However, again, if we break the 200-period moving average on these yields and they get a little bit higher, in other words, a strong break above there, I could be convinced that the equity market should see some type of a pullback. It doesn't have to be 30, 40%, but some type of a pullback lasting more than a couple of days and dropping more than 1 or 2 percentage points. And this is, again, something that really no one else is talking about or bringing up. That's why the ancient ones like us, the folks in the Legion, we've got to keep our eyes on it. If any of you are interested in learning about the Legion, perhaps becoming a Centurion with General Romulus, you can contact me directly, RomulusTeaches@yahoo.com. Again, RomulusTeaches@yahoo.com.